The Dow closed down over 500 points again today, and it has investors worried. How hard were you hit by the sell-off? Jim and Hillary are still with me, and we have our very own Gerri Willis. Gerri has been all over the story. I'm so grateful you're here, Gerri. This is a question that's on everybody's mind about their 401k accounts. Holy mackerel.
Look, you know, if the stocks are tanking like a stone, so is your 401k. In all likelihood, it's all about your asset allocation, the degree to which you're participating in that. But let me tell you what people like Vanguard are telling individual investors today. They're saying don't panic. You don't want to panic in this kind of market and sell. You don't want to abandon stocks and bonds because look, at the end of the day, most folks are invested in the long haul, right? They're not going to need this money tomorrow or the day after tomorrow or next month. It's several years down the road. No abrupt shifts in asset allocation. That's what they're saying today. And there's evidence that that might be happening, that people may be taking money from stocks and shifting them into bonds because of fears. We don't know yet because we only get that report about once a week from ICI, the Investment Company Institute, on fund flows, but that's what we're looking at. My favorite quote here, and this is something John Bogle, who founded Vanguard, says every time we have a big sell-off, and this was a monster one. He says, don't just do something. Stand there.
I love that quote. That's a great quote.
He's saying don't think that you have to get involved in the markets here because, look, if you're buying mutual funds, not ETFs, not individual stocks, you don't even clear in a day. So you can't even tell if the stock price you see on your screen right now is one you're going to get.
You know, but the thing is that you don't want to keep selling in your account because that's how Wall Street makes its money, too, if you keep churning in your own account. But, you know, Hillary and Gerri was all over this, too. I mean, when the market cracked up in 2008, the big asset managers like Fidelity, they were criticized for saying, hey, why don't you get out there in front of this and tell people, take another look at your asset allocation. I mean, you yourself picked your asset allocation. These guys aren't going to trade in your account. But
they've got stuff all over their website these days about what to do and when to. There's all kinds of advice.
But, you know, you can't leave it on autopilot all the time, though, right, Hillary?
That's right. And investors basically have to understand it's a long-term proposition.
As Gerri just said,
every single day, as technology and math algorithms get out there ahead of us, we have to be that much more calm and understand it's a longer-term picture.
Yeah, you'll absolutely self-destruct if you try to market time and react.
Have you seen people do that?
No, actually, I mean, my clients have been with me for a long time. In fact, I would say I was sort of surprised today. The calls I did get were, should we be buying into this rather than panicking? But the key is not to react to a big drop or a big increase. The key is to have a long-term plan.
Don't you think, there were some emerging, we were talking at the commercial break to Gerri about, there's probably mutual funds right now in trouble or emerging market bond or equity funds or maybe a hedge fund.
Well,
I mean, shouldn't you cut out your stinkers out of your portfolio?
If you know what they are. That's just the problem. A lot of individual investors, they don't make those calls. But let me show you something about the markets that I think is worthy of attention, and that's what's happened to stocks over time. We have become so used to double-digit gains in the stock market, and this chart will show you if we have it. Yes, we do. The S&P 500 over the last several years. Yes, it went down 37% in 2008, the S&P 500. That's what we remember, right? But the reality is these gains we've had over the last few years, you thought that was going to go on forever?
Right.
No way.
Everybody called it a new normal. No, it's the new abnormal. But, you know, Hillary, we've had corrections, once on average since World War II, once every 20 months, right? That's normal, right?
And we had gone way too long without a correction.
4 years, right?
Exactly.
Right,
yeah, and what made this particularly dramatic was that everybody's away and the computers took over. And so you have all these quantitative trading. When the market goes down, it goes down even more. That's what happened in 87.
Right, good point.